If I gave you $10,000 right now, would you know where to invest it? What makes one investment better than another? In this video, we're going to give you the tools to answer that question with confidence. No jargon, no fluff, just real-world investing basics you can actually use. Let's dive in. How do we judge the quality of an asset we're considering buying? Well, investors typically use a combination of 5 factors. Let's start with 2 of the most important concepts, yield and return, which is often called ROI or return on investment. Yield measures how much passive income you earn from an investment, usually expressed as a percentage of what you paid for it or of its current market value. It's like asking, how much money is this investment putting in my pocket each year compared to what it cost me? For example, if you buy an asset for $1,000 that pays $50 annually, then the yield of that investment is 5%. If you buy a house for $300,000 that you rent for $60,000 per year, then the house's yield is 20%. Not bad, right? Now, let's talk about return or ROI. The ROI measures the total profit or loss you've made from an investment over time. It includes both the passive income you've earned and any change in the value of the investment itself. It tells you how much you've gained or lost overall compared to what you originally invested. For example, let's say you buy an asset for $1,000. After 1 year, it earns you $50 in income and you sell it for $1,100. That's a total profit of $150. So your ROI or return is 15%. But here's where it gets tricky. ROI isn't always expressed on a yearly basis. There's a big difference between total return and annualized return, and it is very, very important to understand the difference between the two. While some people use these terms interchangeably, they shouldn't, because it makes a huge difference in the money you can make. If you buy an asset for $1,000, which generates $10 per year, and you sell it 5 years later for $1,100, then the total return will still be 15%. While you might think this is good, a 15% return after 5 years means that per year, the return will be 3%. Not quite as exciting, right? This is what we call the annualized return, the average return you earn per year. This metric is crucial because it allows you to compare different investments on the same 1-year basis, making it much easier to see which option is truly better. Now, there's one more key ingredient when looking at return that we're not covering just yet: compound interest. However, it is such a game changer that we're dedicating the next video entirely to it. So for now, just remember, return and yield help you measure how much money an investment can potentially make you. But to judge how good an investment is, that's not all that matters. This brings us to the third factor, liquidity. Liquidity simply means how fast and easily can I turn this investment into cash without losing much of its value. Now, there isn't a specific formula to measure how liquid an asset is. We usually just say whether it is liquid or illiquid. For example, real estate is a classic illiquid asset. Imagine you suddenly need cash because you found your dream car and you want to buy it tomorrow. If your plan is to sell your house, well, first of all, that's probably not a smart decision. But also, good luck. Selling a property usually takes weeks or even months. You could slash the price to sell it quickly, but that would mean taking far less than it's worth. On the other hand, liquid assets like stocks or bonds are more like selling a cup of coffee. You can get rid of them in seconds, often straight from your phone, and you'll get the market price. Selling a house, by comparison, is more like trying to sell a rare collectible. It takes time to find the right buyer, and if you're in a rush, you'll have to settle for a deep discount. As an investor, you usually want an asset to be liquid, because it means that if you suddenly need money, either because you need to pay some debt or because you found another amazing investment opportunity, you can quickly access that cash. This is why liquidity is such a big deal when you evaluate the quality of a potential investment. But here's the twist. Sometimes illiquidity isn't entirely bad. In fact, for long-term investors, illiquid assets like real estate or private businesses can offer higher potential returns, and they can even protect you from panic selling at the first sign of trouble. So while liquidity is usually desirable, there are cases where being stuck in an investment can actually work in your favor. Great, we're now ready to talk about the fourth metric investors care about: volatility. Volatility is a measure of how much and how quickly the price of an investment goes up and down over time. It reflects how unstable or unpredictable an asset's price is. The more it swings, the more volatile it is. For example, Bitcoin is an asset that is very volatile because its price can double or be divided by 2 in just a few months. Between April 2017 and December 2017, Bitcoin's price went up more than 11 times. And the following 12 months after that, it fell to about 1/4 of its value. On the other hand, real estate is not very volatile, since it's very unlikely that a house's value will change a lot over a short period of time. So if an asset is more volatile, it is usually considered more risky, as its value can suddenly swing up or down in a very short amount of time. And understanding risk and knowing how to incorporate it in your investment strategy is mandatory if you want to become great at investing. This naturally brings us to the last pillar of investment quality: risk. So, what exactly is risk? In investing, risk measures how probable it is that your investment won't perform as well as expected, or worse, that you could lose money. It's the uncertainty around your return. Take this example: lending money to your friend Dave so he can launch his luxury hamster yoga retreat business. If it works out, you're an early investor in the next big wellness trend. But if it flops, and let's be honest, it probably will, you'll never see that money again. This is high risk, high potential reward. On the other hand, putting your money in a government bond, something steady and boring that we'll cover in a future video, will likely give you a lower return, but your money isn't out there teaching downward-facing dog to rodents. This is low risk, low reward. This is why, in investing, we always talk about the risk versus return trade-off. Generally, the higher the potential return of an asset, the more risk you're taking, and vice versa. If an investment is very stable and predictable, the return is probably going to be lower. In short, free money does not exist. If someone guarantees you high returns if you invest in something without any risk, it's just a scam. Every single asset comes with a trade-off: how much it can make versus how risky it is. There is no exception to the rule. None. But don't panic. This doesn't mean you're doomed to mediocre returns. Some optimizations exist, and so do incredible opportunities. After all, if they didn't, billionaires wouldn't be a thing. So, what if I told you there's a way to balance those trade-offs? A way to keep risk under control without settling for tiny returns. A recipe to combine the 5 factors we've talked about to find the best way to invest. That's exactly what portfolio theory is all about. A simple idea with game-changing power. In the next part, we'll dive into how it actually works. If you're watching this video, it's probably because you have money you want to invest and you want to decide what's the best way to invest it. You have different assets you can purchase with that money: real estate, bonds, stocks, gold, cryptocurrency, art. How you decide to split that money across different assets is called your portfolio. Some investors might have portfolios more heavily focused on real estate, others on stocks, and some others might go all in on gold. Great. So what is portfolio theory? Well, as you might know, rich people want to become richer, and in order to do so, they need to figure out what's the best way to split their money across different asset classes. The problem? Finding that optimal split is not easy, which is why mathematicians working in banks, hedge funds, and investment firms try to come up with complex formulas helping them answer the question: given your risk tolerance, return goals, and need for liquidity, what's the optimal way to spread your money around? Portfolio theory was introduced by Nobel laureate Harry Markowitz in 1952 in a paper called Modern Portfolio Theory. In this paper, he he showed mathematically how mixing assets with different risk and return profiles can optimize the balance between risk and reward. And if there's one sentence that can help summarize his findings, it is this one: don't put all your eggs in the same basket. Basically, mathematicians such as Markowitz have shown that you shouldn't rely on just one investment type, because if it fails, you could lose everything. I know it sounds simple when you put it like that, but you don't realize how many people decide to go all in on a certain asset because they are convinced it's the best investment ever. But you know what? No investment is the best investment ever. And you know why? Because every single investment can be dramatically impacted by thousands of external events that are completely outside of your control. To convince you of this, let me give you two examples. The first one is about Enron. Enron was a Houston-based energy and trading company that, during the 1990s, was seen as one of the most innovative and fastest growing firms in America. So at the time, if you had invested in Enron, you were quite confident that your investment would continue to go up in value over time. History proved otherwise. In 2001, Enron filed for bankruptcy. Filing for bankruptcy is a legal process where an individual or a company declares they cannot pay their debts and seeks protection from the people they owe money to, their creditors. In other words, in 2001, Enron declared it had lost all of its money in one of the largest corporate collapses in US history. So how did such a company crash overnight? Well, it was revealed that Enron had used complex accounting tricks and off-the-books entities to hide billions in debt and inflate profits. On top of that, Enron was widely praised by analysts, media and investors. It had strong reported earnings, a charismatic CEO, and was considered a cradle of innovation. In that case, even being a genius investor would not have prevented you from losing a lot of money from this investment, because there was no possible way you could have predicted all the dirty tricks Enron had been using. The other example I want to use is the financial crisis of 2008. Initially, it started because a lot of Americans were not able to pay back their mortgage. At the time, if you were buying a house in Ireland, you might believe this was not going to impact you whatsoever, right? Unfortunately, countries are so tightly connected economically, especially to the American economy, that in just a few months, house prices in Ireland fell by 50%. Yes, you heard that right, 50%. In Spain, prices fell up to 40%, and several other countries were hardly hit by this crisis. Now, here's the thing. I'm not telling you this to freak you out. I'm telling you this so you're ready, because no matter what, at some point, things will go wrong. That's just how investing works. And you know what? That's totally fine, if you've prepared for it. See, smart investors don't waste time trying to predict the next Enron or the next financial crisis. Instead, they diversify. They don't shove all of their money into a single bet. They spread it out. They stay patient. And they play the long game. When you do that, even if one of your investments gets crushed, the others keep you in the game. And over time, that's how you build real life-changing wealth. Because in the end, investing isn't about being right all the time. It's about making sure you're never wrong enough to lose. Before we wrap up, there's one final concept you absolutely have to understand: opportunity cost. Opportunity cost is what you give up by choosing one option over another. In investing, that means asking, if I use my money to buy this asset, what other opportunities am I missing out on? Let's see how this plays out with a simple example. Imagine you have $100,000 sitting invested in an asset earning 1% interest per year. That's $1,000 in annual return. Not bad. But let's say you could have instead invested that same $100,000 in an asset earning 4% per year. That's $4,000 annually. The difference between the two, $3,000 per year, is your opportunity cost. In other words, by sticking with the lower return option, you're missing out on $3,000 you could have made with a better alternative. And it gets worse when taxes come into play. Let's say the 1% return you were excited about is taxed at 50%. That leaves you with a 0.5% return after taxes. Meanwhile, if the other investment gave you 4% tax-free, your real opportunity cost is now 3.5%, a full $3,500 per year. Over time, that adds up fast. And here's what's crazy to me. Many people don't even realize they're losing money this way. They see a decent return and stop there, without asking the key question, could I be doing better with my money? That's what opportunity cost is all about. Not just choosing a good investment, but making sure it's the best use of your money, given everything else out there. So next time you hear about a great opportunity, remember, it's only great relative to your alternatives. Always compare, always ask, always think in terms of what you're giving up. Great, it's time to wrap it up. In this video, we've covered the key factors that define an investment. Yield, which tells you how much passive income you're earning. Return, which tells you how much you've actually gained or lost. Liquidity, which is how quickly you can access your money. Volatility, which measures how much prices swing up and down. And risk, which reminds us that every investment comes with uncertainty. You've also discovered how smart investors use portfolio theory to diversify their investments, find the right balance between risk and reward based on their appetite, and that the number one rule this theory gives us is that you should never, ever put all your eggs in the same basket. Finally, you now understand why opportunity cost matters just as much as return, because doing nothing with your money or doing the wrong thing often has a hidden price tag. Now, here's the thing. Understanding all these factors is powerful, but it's only the beginning, because there's one concept that takes everything we've talked about today and supercharges it. A force so powerful that, if you understand it and use it correctly, it can quietly turn small, consistent investments into millions over time, without you winning the lottery, taking huge risks, or working 80-hour weeks. It's called compound interest. And it's not just a mathematical trick, it's the closest thing to financial magic that actually exists. In the next video, I'm going to show you exactly how it works, why Einstein supposedly called it the eighth wonder of the world, and how you can use it to make your money work harder than you ever thought possible. See you in the next video.